The big question on everyone's mind is whether SOFI can reach $25 by 2026. In fact, if you take a look at some of the company's own numbers, it stands to suggest that they can even reach $31.60 by that time if all the tailwinds actually line up for them in the coming years ahead. Now, I believe Anthony Noto has actually given us some insight into SOFI's business and how it could possibly perform in the years to come. Now, we can use this data to objectively determine whether or not SOFI is really undervalued or just another meme stock that is, bound to stay depressed forever. Now, we are also going to talk about what we expect SOFI to do from 2026 and beyond, and basically look at some potential catalysts that can boost the earnings for the company. But as always, potential is a dangerous word, so let's dive in. Now, I want to preface this by actually saying that valuation is both an art and a science, and it's important for you and me to basically identify our own biases as we go through the valuation model. So please take what I'm saying with a large grain of salt, and basically all I'm doing is walking you through my own thought process, and you can see which side of the fence you fall on. Now, there are many different ways to do valuation, and one of the most common is actually using the PE ratio. Basically, as investors, what we are doing is that we're paying a multiple on the company's earnings, and we do not want to pay too high a multiple. So for me, I think I sort of alluded to this in the previous video, that how I like to think about valuation, right, is some sort of function between, the sentiment and the execution of the company. So basically, how I see it is that price equals to sentiment times execution. So what this means is that if a company is cheap from a valuation standpoint, it's either due to poor sentiment or poor execution. Now, execution is, fairly straightforward. This is basically in the earnings per share or the EPS of the company, which we want to see growing at a healthy rate. So for young growing companies, I like to see EPS definitely growing more than 20% CAGR, because that is a double in terms of their net income within 5 years. And that's how I'll be judging SOFI. And when it comes to sentiment, I think this is a reflection of the company standing in the eye of the investor, and this metric is slightly more subjective. Now, not everything with a low multiple is actually cheap, because sometimes companies are cheap because there's a fundamental problem with the business of the company. Or alternatively, of course, it could also be that the market is basically just mispricing the company, and that is where we find the real opportunities in the market. And so the question is, where does SOFI fall on this whole range? I believe the more nuanced conversation to have about SOFI is that to understand SOFI is actually a growing business, and in this part of the business cycle, I think honestly the PE ratio isn't the best measure of the sentiment of the company, because the company is not optimized for the PE ratio, right? I basically, for companies like SOFI who are still in the scaling phase, who are still growing, I like to actually look at price to sales or price to gross profit. But because a lot of the bearish takes around SOFI has been centered around its profitability, so that's where we're actually going to be focusing on now. But let me dive a little bit deeper on this aspect. Now, you consider a company like PayPal, right? PayPal is a mature company. They basically have an expected earnings in 2024 of $4.41. Now, even after their stock ran all the way up to $77, right, it has a forward PE of only 17 times. Now, this PE is a reflection of poor management before Alex Chriss took over PayPal. And despite solid earnings, investors are still wary of the stock, which is why they allocate such a low multiple to the earnings. So from that lens, if you take a look at SOFI's expected earnings coming in at about 10 cents, basically it's trading today at a forward PE of about 77, 78 times. And it will seem like, on the surface, sentiment is okay, but it's actually not that straightforward. Now, sentiment towards SOFI is actually equally poor as well, but we can't really see it through the PE ratio. Now, let me prove it to you. You see, like I said, PayPal is a mature company which is trying to optimize for profitability, right? So basically their PE ratio is, a fair reflection of the sentiment, because this is what the company is actually doing. They're actually driving profitability, making the company more and more profitable. So that's why, as investors, that is the main core metric of the company that we should be paying attention to. However, in SOFI's case, because it is still a fast-growing company, still a company in the phase of scaling up their business that just turned profitable, by virtue of its low EPS, right, investors are sort of, I think for lack of a better word, let's say forced, kind of to assign a higher PE ratio to it. What do I mean? You see, if SOFI was trading, similarly at 17 times forward PE, same as PayPal, it means that SOFI will be worth $1.70 today. And that's not realistic, because if you actually take a look at SOFI's tangible book value, it's about $4 per share, which means that if you strip the company down, sold off all their assets, it will be worth at least $4 per share. So it doesn't make sense, to assign it a 17 times PE. Hence, this forward PE of 77 is not fully indicative of the sentiment towards SOFI itself. And to find undervalued companies is to find companies in which the fundamentals are still strong, but the sentiment is not reflecting that strength. Which is why for a growing company like SOFI, I like to use price to gross profit or price to sales. Now let's consider Upstart, right? Upstart is another popular lender for people who are following the fintech industry. It's currently trading at 6 times price to sales. Now another fintech, a firm, primarily a buy now pay later company, is trading at 5.5 times price to sales. Whereas in SOFI's case, it's currently trading at 3 times price to sales. So how does this exactly prove, that SOFI is undervalued? What makes me so sure that, there's nothing fundamentally wrong with SOFI? So let's take a look at this graph over here. It basically shows revenue since December 2021. And just by looking at the price to sales ratio that has been assigned to, these 3 companies, Upstart, Affirm, and SOFI, the logical conclusion is that Upstart is probably the blue line, the one that is going up and to the right, because that's why investors are willing to pay 6 times revenue, because its revenue is growing at a very fast pace. Affirm is probably the green line because it's 5.5 times, which is in the middle of SOFI and Upstart, and SOFI is probably the red line with declining revenue because investors are only paying 3 times sales. And if that's what you thought, you're right on one of those instances. But if we were to take a look at the legend over here, what we actually realize is this blue line represents the revenue of SOFI, the red line actually represents the revenue of Upstart, and you're correct, the green line is Affirm's revenue. So, let's take a look at everything in context of what just happened. Now, in a tough rate environment over the last couple of years, Affirm basically had flat revenue, and yet they're still priced at 5.5 times sales, right? In terms of Upstart, the revenue actually fell from above 300 million, as we can see over here, all the way down more than 50% to about $130 million in the most latest quarter. And yet, they are still priced at 6 times sales. However, for SOFI, the revenue basically more than doubled over the last couple of years, and yet somehow it is still priced at 3 times sales. Makes complete sense, right? If it is not glaring enough, let me just point out to you that in the most recent quarter, SOFI's revenue is actually 4.6 times higher than Upstart's revenue. In fact, if you take a look at analyst estimates for the full year earnings per share, Upstart actually comes in at negative 67 cents for 2024, and SOFI is coming in at about 10 to 11 cents during the same period. But somehow or other, investors are willing to pay twice as much for Upstart compared to SOFI. And Upstart is basically a company who is not a bank, has no tech platform, has no financial services. And this is why I say PE ratio alone is not a good gauge for a company like SOFI. Because just by this price to sales metric alone, SOFI should be worth double of today's price, which means around $16. But is it really worth $16? Let's dive a little bit deeper. Now, in the previous video, I actually used the analyst expectations that you can find on Seeking Alpha to do some back of the napkin math to basically help me understand where the analysts stand on SOFI and what's their sentiment towards SOFI based on the PE ratio. But what I didn't account for is that I didn't give you time to hit the like and subscribe button if you like this kind of deep dive. Now, thank you for your time, and back to the video. But what I really didn't account for was actually the convertible note sale in the first quarter. If you don't know what I'm talking about, you can actually watch this video over here where I covered it in a more simplified fashion. But basically in one sentence, right, SOFI reported $88 million net income in first quarter of this year. But actually out of this 88 million, 59 million came from a one-time transaction, which is not representative of its entire business. And we have to exclude it when we are looking and valuing the company. But even so, I think analyst expectations are still fairly low. They expect a full year EPS to come in at about 10 cents. And let's just say, they don't have the best track record. Because if you take a look at the quarters that SOFI actually became profitable, the blue bars here actually represent actual performance versus the black bars, which are the analyst projections. And you can see that they are 0 for 3 over here, right? In Q4 of last year, they actually projected SOFI to come in at 0.004 cents. That means less than a cent, and yet actually SOFI came in with an EPS of 2 cents. In the first quarter, same thing, they projected less than a cent. SOFI actually beat, coming in at 2 cents as well, excluding the convertible note deal. And in the second quarter of this year, which is the most recent quarter, they actually, same thing, expect less than a cent, and SOFI still came in at 1 cent. And so on this basis, analysts are basically expecting another further 7 cents EPS to come in the back half of 2024. Now, analysts generally now finally agree that, SOFI are at least going to meet their guidance. And so in Q3, they expect SOFI to meet their guidance and report 4 cents of EPS. And that implies in the fourth quarter of this year, they expect SOFI to do 3 cents EPS. And so, what I want to do right now is to take a look at the underlying assumptions in each of the business segments based on these analyst expectations. And then you can judge for yourself, whether or not it makes sense, whether or not you agree, and which side of the fence you fall on. So let's break it down. SOFI has actually given us the full year 2024 guidance. They actually guided for 2.465 billion in revenue, 615 million in EBITDA, and 185 million GAAP net income. Now, we already have the results from Q1 to Q2. What we're going to do is we're going to subtract these from the full year's guidance and also subtract the Q3 result, which analysts are basically, expecting SOFI to meet expectations, right? So in terms of the Q3 result, we're expecting revenue to come in at 645 million. EBITDA is basically coming in at 165 million, and the GAAP net income to come in at 45 million. So if you take away whatever happened in Q1, Q2, and these assumptions in Q3, you end up with the implied expectations of the fourth quarter of this year being 642 million in revenue, 167 million EBITDA, and 35 million GAAP net income. So basically, I've been trying to track SOFI's individual business segments of lending, their tech platform, and financial services. And what this allows me to do is to model out the changes in each of these business segments and see how it actually impacts SOFI's revenue and profitability. So what I've actually done here is to work backwards using the analyst expectations for earnings, right, to see what it means for the business. Now, let's start with the biggest component, which is lending. And basically, based on analyst expectations, right, they expect lending revenue in the third quarter to come in at a decline of 4% and further continue that decline into Q4 by dropping a further 19%. So for context, yes, definitely, right, SOFI has guided lending revenue in 2024 to come in at 95% of last year's lending revenue. But in a high rate environment, they actually were flat in terms of lending revenue in the first quarter of this year and grew their lending revenue by 5% in the second quarter. So it seems quite unlikely to me that in the third and fourth quarter, with rate cuts underway, that their lending revenue will actually slow down. Then we talk about their tech platform and financial services. Now for the tech platform, basically the analyst expectations assumes tech revenue to grow at 15%, which is basically more or less in line with SOFI's guidance. SOFI actually guided that tech revenue will come in at mid to high teens in this next quarter. And then in terms of the financial services, they actually guided for 80% growth, and basically these two numbers will hold steady across the third and fourth quarter of this year. So of course, you can actually also assume that perhaps lending doesn't drop by so much because of the lower rate cuts, and actually it's the tech or the financial services that actually missed the guidance. But it seems rather unlikely given how Anthony Noto has been on so many interviews recently, and basically the indication that he has been giving is that SOFI is firing on all cylinders, and that's not what he has been guiding for. So I don't really see that as a very high possibility of happening, but of course anything can really happen. But this is where I really have problems reconciling the numbers. Now, personally, do I think the third quarter will be a beat for SOFI? Yes, I do. But if analysts want to assume that SOFI will only meet their guidance and not beat their guidance, I think I can roll with that as well. And I think in a world where SOFI is being ultra conservative, which they have been known to do, I can actually see this happening. But my problem is mostly in Q4. You see, SOFI has played defense for the whole year. Now, analysts themselves can actually see a Q3 revenue coming in at 645 million, which is actually a 22% year-over-year growth in terms of revenue. So I don't see why revenue growth will suddenly decelerate in the fourth quarter of this year to 8%, coming in at 642 million. With rate cuts underway and with Anthony Noto himself saying that they're ready to take advantage of the improving macro, I don't think an 8% growth in revenue is a reasonable assumption. And so on top of the 50 BP cut that the Federal Reserve has already announced, and with more to come, we know that mortgage demand is at least double of the current originations, and the same can be said for student loans. And adding on to the fact, right, that the financial services segment is scalable, it really drives incremental profit, which means that for every new user that they add onto the platform, they don't incur new costs. And so as more people come on board, their profit margin can grow wider and wider. And where this actually eventually settles remains to be seen, but at the moment it's at about 30% profit margin. And so, of course, yes, if SOFI is being ultra conservative, these results could play out. But with Anthony Noto making his stance clear that SOFI is ready and firing on all cylinders, I think SOFI is finally ready to pivot. And so with a price target of $9, basically analysts are saying that SOFI, with all these assumptions, they are comfortable giving them a 90 times PE. Now, I haven't actually really sat down, right, to think about my actual, third quarter projections for SOFI, but I'm basically just going to adjust the numbers to, let it make a little more sense to me, right? And I'll justify it to you as we go along so you can see which side of the fence you fall on. And so basically what I'm going to assume is that SOFI will maintain their low to mid 20s growth rates in terms of revenue going into the fourth quarter of this year. Very simply, the justification is this: like if in a high rate environment, right, in the first and second quarter of this year, they are able to grow revenue at 22 to 26%, then I think in the first full quarter where they can experience the effects of rate cuts, I don't think it's unreasonable to presume that they can maintain this level. And I think where I differ the most from analysts is actually in the net income margin. Now, SOFI actually guided for 45 million net income margin in the third quarter of this year. And I think that they'll come in closer to the $50 million mark. And so that will give them a net income margin of 8%, which I expect them to maintain going into the fourth quarter of this year. Now, how I get to these numbers, right? I think same thing, I'm going to work backwards with my assumptions. and see what this implies for the business. Now, basically when I put my own earnings expectations into the model, lending actually grows at 3% in the third quarter instead of contracting by 4%. And in the fourth quarter of this year, lending will grow at 8 to 9% instead of contracting by 19%. And so in this environment, I think it's a fairly acceptable assumption. In terms of tech platform and financial services, my assumptions are exactly the same as Analyst. For the tech platform, growing at 15% over the next 2 quarters, and for the financial services to grow at 80% across the both quarters as well. So I just think that, with the running off of their fixed deposit loans, with the macro shifting to be more friendly to lending because of the rate cuts, I don't think an 8% net income margin is being overly optimistic. And if you actually say that, but SOFI tell us they'll come in lower, how can you project, so much higher lending revenue? But actually, if you take in aggregation all the lending that they have done this year and all the revenue they would generate, right, it's actually only a 4% growth compared to 2023. And so, like I said, perhaps SOFI's own conservative guidance is coming to bite them in the butt, right? Which is why analysts are not pricing this in, because they keep telling us we are going to grow at 95% of last year's lending revenue and things like that. So they've been guiding for a decline in revenue, but I haven't seen it yet, and I don't think we will see it going into a more favorable macro condition. Now, apart from this, I want to show you 2 charts that make me think that, the 8% net income margin is really doable. Now, if you take a look at the last 10 quarters, SOFI has always beaten expectations. When I was looking at this in the past earnings call, right, I plotted out their guidance versus the actual results for both revenue and EBITDA, and this is what I got. Now, I want to make a disclaimer here, okay? What you see is there are 8 data points over here because there are 2 quarters in which they actually reported second half guidance rather than third and fourth quarter guidance. So because of that, there are actually 2 data points less. So there's only 8 data points in total, but we're talking about the last 10 quarters, okay? Which is why there are also these 2 spikes that you see over here. So if you take a look at this graph, on average, right, their revenue actually beats their guidance by 5%, and in this second graph, their EBITDA actually beats by 54%, and it's actually increasing over time. However, I just want to point out, right, that the EBITDA beating at 54% is actually a little bit skewed because of the earlier data when the EBITDA was smaller. Every time you beat a small number, right, the percentage will come across as very high. So because of that, right, I think this is a little bit skewed to the high side. And if you look at the most recent quarters, they actually beat EBITDA expectations by about 10 to 20%. So basically, all I'm assuming is for this trend to continue, their revenue will come in possibly around 5% higher, and in terms of their EBITDA to come in at perhaps 15% higher than expectations. Now, if you go back into my numbers, you can actually see that for third quarter revenue, right, my revenue estimate actually comes in at 668 million. This is a 4% beat above their own guidance of 645 million. So of course, in the fourth quarter, my revenue beat is by a much larger percentage, but that is because they actually haven't guided for Q4. I'm just implying the estimate from what they have given in the previous earnings. So I'll definitely adjust this again when the time comes and when they actually give the actual Q4 guidance. But at least you know how I get my 2024 numbers, and this is important because this is the numbers that we're going to use to project for 2026 and beyond. Now, along with the catalyst that I actually covered in my previous video, Anthony Noto has always been giving us some long-term projections for SOFI. And so with my previous valuation 2 videos ago, which I'm going to link over here, I basically counted the revenue per product and the number of products that each member uses, and basically helped to drill down into that one fundamental metric to track, which is, basically member growth. But the thing is, right, in the valuation model, what I did is basically I lumped together all their revenue from the 3 business segments into one and to correlate that to customer growth. But actually, that's discounting the fact that SOFI's business actually has a B2C component and a B2B component. So since, their management has very kindly given us guidance for each of these segments, right, I think I want to use the guidance that management has given us to do another valuation model and to compare the two to see how it differs and to look for any blind spots in valuation. So going into this valuation model, there are some key assumptions that we'll be making, and I covered it in detail, in some previous videos, which I'll link over here. But basically, a quick summary is that the first assumption is that SOFI's customer is actually more resilient than the average American because of their high FICO scores and because of their high annual income, making them more recession-proof, not completely recession-proof. Now, the second one is not really an assumption. Now, Anthony Noto has actually, blatantly come out and tell us they have a backlog of tech clients to onboard in 2025, which makes them confident of at least a 20% growth in the tech platform, and that is even in the case of recession. So financial services is the third assumption that we'll be making. We basically assume that this will continue to grow at the 50 to 80% range that they are growing right now. This is quite self-explanatory. If you expect a business to grow at 50% but it's growing at 80%, that is definitely a growing mode for the business. And why, this is a very important component of their business is because this is high margin business, right? They actually already spent the money to build out their offering, and then now every new client that they onboard, every incremental dollar drives more profit than, even their lending segment. And then we have the fourth assumptions, which is, the pace of rate cuts. Now, the Federal Reserve has actually announced their 50 basis point cuts recently, and then Apple has actually, over the course of the year, cut their interest rates for their savings account down from 4.5% to 4.25%. Robinhood has cut their interest rates down from 5% to 4.5%, while SOFI only cut their interest rates down from 4.6% to 4.5%. And so the thesis is already playing out. I think management has told us this time and time again, and we can actually see this playing out, right? Because they are actually cutting their APY slower than the competition around them. Because of that, they're able to gain market share as the Federal Reserve continues to cut rates. And then finally, I think this is not really an assumption, but more like a cherry on top. We already know that they have pent-up demand for housing loan and student loan refinancing, which at least doubles the current levels of originations. So where exactly do we go from here? What has the management actually told us in regards to their earnings expectations going into 2026? Now, if you go all the way back to the end of last year in Q4 2023, management actually made some comments regarding their guidance for 2026. So basically, we know that in terms of the expectations from 2023 through to 2026, they actually see a 20 to 25% compound annual growth rate for revenue, assuming no meaningful change in macro and no new business additions. So what this means, right? I think the key line here is that no meaningful changes in the macro conditions. And what is the macro conditions that they are expecting? If we take a look, actually they're expecting a contracting GDP in 2024, which means in case of a recession, they also expect higher unemployment of above 5% and deteriorating and normalization of credit performance. So basically, SOFI's management is telling us if we have a recession, if unemployment goes up to above 5%, then we will grow the business at about 20 to 25%, which means if the Federal Reserve nails their soft landing, perhaps this can actually grow even faster. All of this also excludes their new business initiatives like credit cards and things like that, which Anthony Noto himself has actually told us can be as big as their current business. This excludes any new Galileo initiative and no small and medium business products at all. So how are they exactly planning to get there? Now, they actually gave us guidance for this as well. They say this assumes a compound annual growth rate for financial services of 50%, mid-20s for tech platform, and mid-teens for lending segment revenue. So how does all of this translate to our valuation model? Basically, for lending revenue, we are going to project out a 15% growth for 2025 and 2026. In terms of financial services, this is a growing arm of the business that is highly profitable, currently growing at 80 to 85% year over year. But I think this will slow down to their expectations of about 50%. So that is what we're going to expect going forward. And in terms of their tech platform, with the backlog of clients, we already know that 20% should be in the bag for 2025. And then that means that they'll reaccelerate this to, the mid-20s range by the time 2026 rolls around. So if this is not something that happens, then this is something that will make me want to relook at this thesis again. So using my third and fourth quarter numbers, you can actually see that the revenue for the full year 2024, I'm expecting to come in at about 2.58 billion versus the current 2.465 billion. So this is actually a 5% beat, which, just nice is around their average range for beating revenue. And if you use the numbers that management give us and project out forward using this 2.58 billion, what you end up having is that in 2025, right, they will have an EPS of 38 cents. Now, analysts right now are projecting EPS for 2025 to come in only at 25 cents. So there is a 50% extra upside for them to price in. And then in 2026, they should reach an EPS of 75 cents, which is also much higher than the analyst expectations of 44 cents. Now, if you remember, I think I've mentioned this before, SOFI has all along guided for 55 cents to 80 cents EPS in 2026. So based on the previous valuation model, where I actually map out, the revenue per product and the number of products each member uses, this is how we actually got 83 cents of EPS using this valuation model. And in this current valuation, where we are looking at the business segment, we are actually getting a 75 cents EPS by 2026. So I will certainly say this is a certainly achievable target. And the fact that we're using two different valuation models and they can actually give us similar results shows me that management is fully in control of the business, and the numbers that they give us is not fluff, right? And all that is left is for the market to price it in, and therein lies the problem. Now, if I take the midpoint of the results of the two different valuation models I used, the 75 cents EPS from this model and 83 cents EPS from the previous valuation model, we get an EPS expectation of about 79 cents by 2026. So considering that we should end the year anywhere between 12 to 14 cents EPS, that puts us at a 6 times EPS growth within the next 2 years. So I think this growth that SOFI is projecting is so exponential that analysts actually find it hard to incorporate that growth into their models. And so basically, if you apply the sector average PE ratio of 50, right, we can get a price of $39.50 by 2026. Now, I know the sector PE ratio might be higher than 50 now because the market has actually risen quite a bit from the last time I made my valuation model, but because I want to keep, the calculations a bit more consistent to compare the results in both valuation models, I'm going to use the 50 PE, which is what I did last time, and it's, always good to be a little bit more conservative. Now, of course, it's up to the market to give this PE ratio, but even at a 40 times PE, right, that means we are taking a 20% margin of safety. We can still get to a price of $31.60 by the end of 2026. So that's why, like I said at the start of the video, basically, if there are a couple of things that line up together and the market actually, price that in, then $31.60 is something that we can potentially get to by the end of 2026 lah. But it doesn't actually end there. Now, where exactly do we go from here? Anthony Noto basically wants to see, SOFI's EPS grow well beyond the decade. But basically what we're going to do is we're going to use his guidance to at least take us to the end of the decade, looking from 2026 all the way through to 2030. Now, SOFI expects EPS to grow between 20 to 25% beyond 2026. So to the end of the decade, that's what I'm going to use. I'm just going to take management at their word while performing my valuation. Now, when it comes to valuation models, I think sometimes when we go too far out, it involves a lot of assumptions, and the more assumptions we put into these valuation models, the more chance for error and inconsistency to affect the valuation that we get at the end lah. And so basically, there are two ways to do this. Firstly, you can slow down the revenue, and then you adjust the margins to find the EPS, or you can just take the 2026 EPS, and then straight away just apply the growth percentage to it lah. So I'm going to show you both methods, and then we're going to take the average of the results. So for me, I expect revenue to slow down from 30% growth all the way to 25% and finally to 23%, right? By the time 2030 comes around. Now, during this time, the expectation is that SOFI hits their long-term EBITDA margins of 30% and net income margin of 20%. Now, with that, and with share dilution factored in and all that, their EPS will be slightly more than double in the next 4 years, right? Having a $1.61 EPS by 2030. That is if they reach the 75 cents targets by 2026 lah. So if you look at the EPS growth, it falls within range of SOFI's guidance, albeit the lower end of the guidance, right? It actually shows you that in 2027, there's a 21% EPS growth, 28, we see a 23% EPS growth, and then 29 and 30, both 21% EPS growth lah. Now, if you want, what you can also do is to just take, the 25% growth number that management has given it to us, and then you just, slow it down manually on your own. So basically what I've done here is to take 25% growth from 2026 for the next 2 years, in 27 and 28, right? And then to apply a 23% growth for 2029 and 2030. And so with that, you end up with an EPS of $1.76 by 2030. Again, the numbers are pretty similar. So if you take the average of these two models and apply a PE multiple, you get a range of the stock price between now and 2030. And for all you know, right, SOFI has a PayPal style collapse and gets assigned a 20 times PE in 2030, which would make it worth, only $33.70. Now, if you consider that we really hit the $31.60 target in 2026, it means you held on SOFI for another 4 years for $2 in terms of capital gains. Now, but if we get the sector average PE of 50, then it could be worth $84 in 2030, in which case it has slightly more than double in the next 4 years thereafter lah. But you know what? I'm really not a fan of doing this, because you can just assign any multiple you want to make yourself feel good about the company that you're holding, and it doesn't really tell us anything. Guessing where the market is going to be is really a fool's game. So for me, that is why I like to focus on the fundamentals of the company, and that is how I found this company, which went up over 25% in the last 2 weeks. And I talked to you more about it in this video over here, and I'll see you in the next one.